Astrapak. Their full-year headline earnings per share down 68% to 18 cents. Company was hit by a nationwide transport strike and a fire at one of its businesses. Robin Moore, CEO of Astrapak, joins us for more. Good morning there, Robin. I want to take you back for a moment just to your last set of results where there was a lot of gloom and doom that you were dealing with. You talked about greater efficiencies needed, changes in management, poor working capital management, the need to reduce debt levels, and you needed to focus on market niches. It sounded like there was a lot to do. Have you done it?
David, no. In fact, I think we haven't achieved everything that we wanted to. As you've said, our headline earnings are down 67%, affected by the strike, affected by the major fire that we had at our East Rand Plastics facility, and that did delay certain things. I think also the board realised and the company realised that there was a need for significant change, and so we've made a lot of those already. Obviously, I'm new to the business, having only started on the 1st of November. But having said that, I think there are a lot of positives in the results. You talked about gearing and needing to reduce it. That has been attacked. We may not have achieved as much as we would have liked, but we certainly reduced the gearing from 51 down to 39%. In terms of working capital, there has been a significant improvement. We've reduced the days from 51 to 45, and clearly we'd like to improve that going forward. But I think underlying all the underperformance, the real positive for us is that we've managed to maintain a growth trajectory of about 4%, notwithstanding the own goals and some of the issues we've had in the marketplace. And I think that sets a very good platform for us going forward.
Robin, you have highlighted that the recovery process that you're now well underway with is a 2-year process. So moving forward, where does the priority for you lie?
I think initially, clearly it's about stabilising the base in South Africa. We've restructured very quickly from the legacy operations and the regional structure that we had. We've got 23 sites around the country, pretty much have operated independently up until now. What we've done in the last couple of months is we moved to a divisional structure. So we've created 4 very strong businesses in terms of a moulding business, a PET business, a forming business, and a flexible business. And alongside that, we have a small development unit or division in which we've put our high growth businesses and 1 or 2 businesses that need special attention. So really that's been the focus, put the structures in place, get ourselves into a divisional footprint where we can really start maximising the synergies. We can build on the strong platform that we have. We've got very strong market shares in a number of those areas. In fact, we're probably market leader in all of our chosen sections. We've got modern equipment in all of our facilities. And I think we've got a strong and very loyal customer base, notwithstanding some of the issues that we've been through. And finally, I think the big thing for us going forward is that we've got a very strong position in the market. I mean, if you look at the plastics market overall, we've probably got a 10% share of that. We're probably the leading player in South Africa. And in terms of the overall packaging market, we've got about a 5% share. So we're actually in a very strong position if we look at those fundamentals and well placed to actually turn the business around going forward.
Robin, with us here in the studio is Francois du Plessis from Vega Asset Management. Francois, you got a question for Robin?
Yes, Robin, no ordinary dividend was declared. When can shareholders expect the next dividend, and is your preference share dividend under threat?
No, Francois, to answer your question, I think first of all we have paid the preference dividend this year, so there was no threat there. In terms of the ordinary dividend, we've taken the view that we need to have a sustainable level of earnings before we can recommence dividend payments. Obviously, we'd like to do that as quickly as possible, but we need to turn the business around and improve our earnings before we can deliver that.
Robin, you talk about the environment that you're operating in. As you say, on the one hand, well-placed, big company, established relationships with customers, so you're well-positioned. On the other hand, the environment you're operating in has been tough, and you've had your internal issues. If you could give a weighting, 50-50, 60-40, how much of your problems have been internal and can be fixed, and how much has been the environment that you've just had to deal with?
I think just answering that, David, the really positive thing for us is it's unfortunate that we have to accept it and acknowledge it, but a lot of our issues have been internal. We've scored a number of own goals. We've clearly had inflationary pressures, but I don't think we've done as well as we could in terms of recovering prices. and some of our quality and service and delivery has not been at the standard we would like, and therefore we've had a lot of internal efficiency and inefficiency costs that we've had to absorb. So the positive coming out of that for us is clearly there's an intrinsic value or underlying value that we can unlock within the business, and that means that we don't necessarily need growth or significant capital investment to actually improve the earnings going forward.